Hello traders, welcome to this live intraday strategy webinar on SB Trade Desk. Mike Boutros here with you this morning. We just got the release of Canada GDP for the month of April, coming in broadly in line with expectations. You saw the month-on-month figure coming at 0.1%, right in line with expectations. Year-on-year headline figure coming in slightly stronger at 1.54. Here's what the Japanese yen looks like today. We'll go over this setup in just a moment, but it doesn't look like we'll get too much play off this just yet. If anything, you should see some CAD strength, possibly give us a drop into that 526 low, basic 50% retracement at 128.99, basically 129. And we'll be looking for some possible support here on the loonie. Okay, now that we got that out of the way, we'll continue to follow the loonie. We'll come back to this in just a moment. As far as the remainder of the session is concerned, guys, here's what the docket looks like. You don't really have much on tap for the remainder of the day here in the United States. You do get some data with regards to Chicago Purchasing Managers Index. That comes out at 9:45, just after the conclusion of our webinar here. Expectation for a pop back up into positive territory above 50 with a read of 51. So keep that in mind for any of you who have any positions open here for the loonie. All right, let's jump right into the charts. Good to be with you guys here this morning. Eileen says, good morning, Michael. Hope all is well. Happy end of the month, end of quarter, end of 6 months, and a holiday weekend. Thanks for that, Eileen. Yeah, so a moment before we get started here, guys, I really want to stress today's price action is likely to be very tricky. I'm going to tell you right now, as a disclaimer, I'm on the sidelines for the rest of the month. Well, basically today, as we close out the week here. I typically just don't see personally, I don't have really good performance during this time period. Remember, it's the end of the quarter. It's the end of the month. There's a lot of rebalancing happening, especially in light of the events for the last week. As Jamie noted in his piece yesterday, there's a lot of forced liquidations, going to be a lot of jockeying for positioning, and this can make for very difficult trading environments on the near term. So once again, guys, I know it's been sort of a theme for the last week with the Brexit and now this quarter end. It's not the best ideal condition for us to be trading intraday. Now, that doesn't mean there's not opportunities. It just means that trade sizes should definitely be dramatically decreased as far as your leverage is concerned. And you really want to be checking out or cherry picking, rather, those entries for the positions. Amir says, hi, Mike. What did you guys mean about the tweet on the squawk regarding the month-end FX hedging rebalancing? Yeah, so a lot of times, Amir, heading into the end of the month, there's going to be a lot of portfolio rebalancing. Guys closing positions, rolling over positions, reestablishing new positions if they got liquidated on the sterling drop out there on Brexit. So this can really shift intraday price action, right? As these bigger players really, as Jamie says, it's common terminology, on the trade desks, jockeying for positions, you'll call it. So you'll see a lot of back and forth action. Sometimes looks random, sometimes doesn't really make much sense. But this is sort of an expectation of flows that we get as you come into the quarter ends and in the monthly ends. And specifically, Amir, I really can't stress enough, on the back of the major shock markets just got with the Brexit vote, wouldn't be too surprised to see some of that wicked price action really start to work its way through the U.S. session heading into the close. Amir, does that make sense? Yen, JPY are buying XX yen crosses. I mean, it's going to be, give me a specific example here of a pair that you're looking at, Amir. I'm not really paying attention to the yen crosses right now. I think that's a high risk trade. Just because I don't really think we have clarity on whether this rebound that we're seeing in broader risk is going to be the full-on reversal and stretch into new highs. It's going to be a very interesting 24 hours, I'll tell you that much right now. He says it was on the tweet. Oh, it was on the tweet that Jamie just put out. Yeah, so I know Jamie's watching the yen crosses much more closer than I am. But certainly we'll be going over those here in the webinar. So let me know if you have any specific questions. Oh, I found the tweet you're talking about. Month-end FX hedge rebalancing predicts yen buying. So everything versus the yen crosses selling, basically. sterling selling and moderate dollar selling against the major currencies. So yen strength, Amir, is what he's basically saying, right? So dollar yen lower, Aussie yen lower, sterling yen lower. We'll definitely take a look at sterling yen if you guys want. Still a very high risk trade as far as I'm concerned, but we can definitely map out some of the key levels for sure. No worries on that. All right, so let's jump right into price action. Before we get started, a quick note. You're going to see a quick phase over, guys. Actually, I should take that back. It's not going to be a quick phase over, but I'm certainly going to be moving us over into trading view charts over the next days and weeks. It's going to be a long, arduous process from my end, obviously, with all the charts that we follow here in the intraday webinars. There's going to be a lot of work to transfer all those over to TradingView. But a very robust trading package. You know, I had my issues with TradingView when they first reached out to us a couple of years ago, but since then they've made some awesome upgrades to the software. And I think it's prudent for us to move at this point. You know, I waited long enough, and I think that if you guys are interested, check it out, tradingview.com. It's free to open up, the demo there and work with the charting package. So definitely something I would be encouraging guys to check out. Aren't afraid of losing charts to the cloud, Eileen says. Eileen, that's my most terrifying fear, to be quite honest with you. But it seems pretty stable at this point. And like I said, they've made a lot of upgrades on the back end. You know, they reached out to us like a year ago trying to get us to use TradingView charts. I know that they've already implemented some of this on Daily FX. But the convenience factor of doing your research, going home to right there on your desk, coming back to the office, right there on the desk. As far as the charting tools are concerned, also very robust. Whether it's pitchforks, fibs, whether it's the ability to copy pitchforks, easily overlay charts, it's all there. So definitely encourage you guys to take a look at it. Is there a way to save charts created there to the desktop? I don't think there is, Eileen. It's all pretty much just cloud-based. So I do not think you can save these on your desktop. Okay, we'll still be using MarketScope. Again, MarketScope has its own gigs. Obviously, you can bring SSI up on this right off the bat. So it does have advantages, and we'll still be using this, more or less during our trading. But as far as the analysis is concerned, you're going to start to see a lot more MarketScope, TradingView charts on the reports. Yeah, Eileen looks like she has a little bit more apprehension here. Don't worry, Eileen. But as always, guys, your feedback is always appreciated. So if there's anything in the charts that you say, hey, this looked a little bit better on MarketScope, I'm more than willing to try to accommodate. Amir wants to look at Euro, CAD, and Sterling Yen, if you don't mind. Sure, let me write that down. All right. So like I said, I'm in the process of transferring these charts. I only have a handful that are actually on TradingView at this point, but we will be going back and forth for now till we get everything transferred over. So first things first, relative performance for the US dollar heading into the open looks like this. Again, last day of the month, you do have some Swissy strength here, up 0.25%. We'll go over that trade that we highlighted in the intraday charts a couple of days ago. Pound, nice little rebound, up 0.15. Yen almost unchanged on the session. Euro, biggest loser, down 0.31%. Aussie and CAD also with a share of the declines there. A quick interesting thing I just wanted to note, guys, the Fed fund futures have been dramatically outsourced, or pushed out rather, as far as the expectations here. We now have reads heading into September of next year. And I just wanted to highlight a couple of interesting notes. Earlier in the week, I showed you that the probability of a cut heading into November was somewhere in the range of 11%. Okay, it looks like some of that market fear and some of that panic has sort of panned out already. So you're seeing the expectations for a Fed rate cut really completely drop off the plane here. So that's not really the focus. The focus is, however, on the interest rate hike probability. Okay, and certainly you can see a dramatic shift from what we were looking at just a few weeks ago here. In fact, if you guys go to SB Trade Desk, you can always type in WIRP, and you'll get the latest Fed Fund Futures chart that I've been published. So the last one that we published was on the 14th. Here's what it looked like. Okay, you had a 51% chance for a February rate hike. February now stands at just 11. Okay, and you can see that across the board, really. Even heading into November and December, 33 and 48. November and December here now showing 2.1% and a measly 11%. So that is to say that interest rate expectations from the market's point of view, what the market is pricing in, have pushed it out completely for no hike in 2016. Now, that's not to say this can't change, but certainly in the near term, it suggests that the markets are not expecting any type of tightening from the Federal Reserve. Okay, if anything, that should kind of cap dollar advances. Now, the dollar is still catching a bid, or has been catching a bid over the last couple of days, just on sheer risk-off flows that we saw with that massive drop-off. Obviously, over the last 2 days, you've seen the markets and risk markets start to rebound a little bit. Dollars come off a little bit. But for the dollar advance, that advance is not going to be based on interest rate expectations or differentials any longer. Okay, anytime that you see the dollar really start taking off in this environment will likely be triggered by a risk-off event or an equity sell-off or something to that degree. Does that make sense, guys? So as we continue to track these expectations for Fed rate hikes, it's important to know what the dollar is doing. Is it rallying because markets are expecting higher rates? Or is it rallying because there's a sheer risk-off trade? Everyone wants to be in the relative safety of the greenback. Okay, so that's just a little tidbit there that you want to continue to follow as far as interest rate probabilities are concerned from the Fed. Moving into yesterday's update, let's go ahead and jump into the charts here. First thing on tap last night I wanted to highlight was the Kiwi Dollar. Here's what Kiwi looks like. First on the daily chart, and then we'll jump into the 30-minute. So not much really going on here of note, except, we'll show you the 30-minute in just a moment. But on the daily chart, the real main level that we're following of support, 69.70. If you remember, we had a support zone here into 70. I want to go ahead and clean that up. Just leave it with the 50% retracement. This is also last month's open. And near-term resistance, oddly enough, what we failed to close above yesterday was the simple high day reversal close, the outside key reversal we made here on the 23rd. Okay, and that high day close capping the advance, or at least on a closed basis, failing to push through it yesterday. So that gives us a little bit more of a conviction near-term resistance that we're looking at. Here's what it looks like on the 30-minute charts. Okay, and you can see some consolidation right off that Friday low. So here is the spill-off, obviously, on Brexit. You see we've been in consolidation ever since, a series of lower highs, a series of higher lows, with an embedded channel here in the middle that we highlighted last night saying, look, as long as we hold within the confines of this channel, the trade remains constructive. At the end of the day, we filled the gap. Momentum has continued to hold 40 support on the way down. And basically, you're looking for some possible moves higher here in Kiwi to get short. Remember, the broader trade, let me just take a step right back. The broader trade has us at resistance here, okay, at channel resistance. So it wouldn't be outside the realm possibility to see us stretch into that 618 one more time before moving off. Okay, so for the 30-minute chart, the implications are pretty clear. If we do see a break below this, the near-term bullish invalidation level that I noted yesterday is going to be the weekly open, which currently comes in right around 70.70. And a break below that, you'd be looking for a drop right here into confluence support, or basically just the lower parallel. The lower trendline support off Friday's low. And this would be the broader bullish invalidation. So if we break there, there's really nothing on tap. Look for a quick tap of 69.70, which is the low from Friday. More importantly, a drop into 68.77, and that would satisfy a basic 38.2 retracement. All right, so the focus is higher while within this channel, but again, you're looking at this thing right now continuing to consolidate. So if we do break the downside channel, I'd be looking for a rally back towards channel support as resistance to get short, looking for a tag of that lower parallel. Ideally, guys, in an ideal world, you get one more breach here. You're rallying to the 618 retracement. and you find some resistance up there. And I think that for me would be a much more conviction short exposure. If we bring this to a 4-hour chart, just to give you a little bit more breadth here, to show you where we are in trend. Typically, these consolidation patterns are continuation patterns. So that would suggest on the drop here from that key reversal we made on Friday that you would see another leg down. So looking for either a rally into 71.70 to sell, or looking for a break below channel support for a rally after a post rally to sell that into basic trend line support off the lows. Any questions on the Kiwi Dollar before we move off? Head and shoulders in Kiwi Dollar, says Eileen. It could be. It'd be an ugly one, but either way, if you were looking at a head and shoulders scenario, you'd be wanting to see a break of something like this, Eileen. It's gonna take me some getting used to get used to this charting package, guys. There we go. Right, that would be the neckline. So either way, even if it is a head and shoulders, that play wouldn't even come into facet until you break up below Friday's low, essentially. So that's the thing with head and shoulders, guys. A lot of times it can be, but the problem that typical retail traders run into is that as soon as they see a high, then a higher high, now all of a sudden they're looking for head and shoulders. That doesn't even come into fruition, shouldn't even come into focus as a formation until you break the neckline, and that's actually the signal for the measured move. So it could be. I would love it, to be honest with you, but in the near term, I'd be looking for that rally towards 71.70, 71.60, this region right here. If you look back far enough, guys, this purple line that you see here is actually this. Okay, so it wouldn't be outside the realm of possibility to get one more spike into this region and move off. That being said, look for a break of this channel to offer some conviction on the short side. Eileen says, for the ways to go for the break, your thoughts for a rally better? Yeah, I think that's the better approach if we can get that spike into the 618. So quick note, guys, actually, while I'm here on the new Market Scope charting package, something I want you guys to know so you can get a little bit more clarity on the charts here. For the intraday charts, these gray circles will represent the weekly open. Okay. On the daily charts, these beige circles, or a little bit darker color, will represent the monthly opens. Okay, so you can see both of those here on the intraday charts as well. This is your monthly open, weekly open, weekly open. Last week's open was almost dead on with this week's open, despite all the volatility that we got. But you get the picture. Are those circles automatic? Those circles are not automatic. They are an add-on indicator. They're an indicator called you can download it, Eileen. It's called right here. Chris Moody made it. It's called Code Plots High, Low, Open, Close, Daily, Weekly. Okay, and it basically allows you to designate whether you want to highlight the high, the monthly high, the weekly open, the weekly close, and you can choose what factors you want to be highlighted on the chart. So just do a quick search in the indicator field for code plots from Chris Moody. You got it. Anytime, Eileen. All right, so that's Kiwi. Let's move right on. Next up on tap was Euro Dollar. Here's what Euro looks like or looked like last night. Okay, on the daily chart. Oh, I might have reversed this. This is actually the daily chart, guys. Sorry about that. I will fix that in just a moment. But here's the daily chart looked like yesterday for Euro Dollar. Here's what it looks like right now. So, pretty clean as far as price action is concerned, and so is our median line level. So what we tagged yesterday as a resistance and came right off of was the actual concerted monthly open. That was 111.28, 111.29. Also note that, on the 30-minute chart, I guess I should just bring that up. That level also represented a basic 618 extension from the ascent off that low. Okay, I'm not going to use the emotional low there. I'm going to use the low that we're using for the formation here. And if you use that extension, the 1618 was the exact high that we ran into yesterday, and it was also, like I said, just above it, one pip higher is the monthly open. Okay, so I'm not surprised to see some struggle here. And in fact, this is kind of the barrier of entry. The ideal scenario here is very similar to what you're looking for in Kiwi. Okay, ideally, all things held constant in an ideal world, you would see another rally here push through, come into this major critical region of resistance. Confluence, my favorite fib confluences, as I always tell you guys, 100% extension off the low, 618 retracement off the high, gives you a range of 112.24, 112.30. That's sort of the cherry spot where I think you can get a little bit more kickback. That being said, you still have some structural resistance higher. Okay, if I zoom this out, let me just take you to a 4-hour for a moment. The basic median line off the highs, you have current channel resistance. Okay, and just below that, the 50% retracement gives you a range of like 111.70 into 111.85 of major resistance before we even get into that 112.30 region. So, again, you're going to see back and forth. It's the last day of the quarter. I really wouldn't be surprised if this thing makes a stretch in a 30-minute candle into that region and reverses. I just don't know. Like I said, these conditions are very difficult for near-term trading. So from this standpoint, I'm flat. I would be interested in a short trigger or looking for short triggers on a rally into this region or on a downside break of this channel and a retest of it as support, as resistance rather. So if we break below this, rally tested as resistance, that would be a short exposure looking for another run into the parallels. Ideally, you're still looking higher within the confines of this with a topside break looking for this region here. And again, ideally 112.30, if we can get up there, 112.24 would be an area of interest for me. All right, keep in mind the momentum signature still hasn't turned over. Okay, you've held 40 support essentially since the lows that we made for the week. Here's your weekly open. You made that low. We filled the gap, came right back into the lows and failed, and then broke the highs. So objectively, it actually is almost a weekly opening range here well above 110.80. Any questions on Euro Dollar? Immediate resistance right here at 111.27, 111.28. Again, the monthly open in that 618 extension off the low. A quarter of the daily ATR is not showing on TradingView. Good point. Good point. I'm going to jot that down. I'm sure there's an indicator for it. The beauty of TradingView, it's actually pretty simple for us to find, outsource, and code indicators. So if we do need to make that, we will go ahead and do that. But good point. Didn't have that on there. That's what TradingView will still be necessary for now. So if we take a look at the Euro Dollar on TradingView here, 30 quarter of daily TR is about 31 pips still. Okay, next up on tap from last night was the dollar CAD, and I kind of just want to touch base on this, obviously on the back of the release that we got. Here's what the dollar CAD looks like on the daily chart. We ran right into the May high day close, literally to the pip. It was also just above the monthly open, and then we got the pullback. So for dollar CAD from here, here's what I'm kind of working with. Okay, so again, you had the 100-day moving average, high day close from May, and the monthly open. Okay, went around 130.92, all stacked up right here. Kind of tried to make it through early in the week, failed, filled the gap, and then broke lower. Remember, I always tell you guys this, when you make these gaps on the Sunday Open and you fill the gap, a lot of times you can play that range in and of itself as an opening range. So if you fill the gap, it pulls back, and then you break lower, or you fill the gap, it pulls back, then you break higher, that will be your directional bias on the near term moving forward. So here's what it looks like on the 30-minute, long story short. Okay, here was the gap. You made an opening range high. You filled the gap. Again, you tried to test the highs into the yearly or the monthly open, that failed. Break below the opening range low for the week, shifts the focus lower, tested it as resistance, still holding. So you have a couple of levels of support interest I'm looking for right now. First, you have the swing low that you have here from the 26th of May. Comes in right at 129.10. More importantly, a basic 50 matches up very nicely with Friday's low. Okay, and that's 28.98. So do be mindful of the building divergence here in the intraday chart. So you made a lower low in price, a higher low in momentum. Suggests that if you do get a new low here, it might be an exhaustion spike, actually might give you an opportunity for a near-term long exposure. The weekly open comes in, or the weekly opening range comes in low, the weekly opening range low comes in at 129.66. So that's your interim resistance level for this dollar CAD move. Bear with me one moment. I just want to see what this looks like. Okay, not going to stress that at this point. Okay. So with the divergence you're seeing here in the low, again, I have no positions on this. Moving forward, I would be interested in either looking for a long trigger on a drop back into that Friday low with a break above this trend line, may offer a near-term long trigger. Again, a quarter of the daily ATR for dollar CAD looks like this. It's about 35 pips, so you do have some room to play with. But that's sort of the game plan I would be moving forward with on dollar CAD heading to the US session. Remember, broadly speaking, the daily chart's coming off some resistance here. So there is room to the downside if we make a break below this key region here, 29.10, 129 handle. Yeah, it could be a falling wedge, could be a little consolidation pattern before we try to break higher. But look for some support down here. Are you taking near-term charts out longer term, like 60 minutes on dollar CAD? I've been doing it just to help with the analysis here because I'm going way back and I'm having to update. I literally have to go through like 70 charts, guys. So no, for all intents and purposes, we're going to stick with the 30-minute for more of a momentum profile, for more of the mapping out the key levels. But with some of these pairs that are so stretched, maybe not in dollar CAD, but pairs like sterling, even some of the sterling crosses, I've just been kind of working with a 1 hour, sometimes a 240-minute. You saw me post on Daily Effects yesterday. But this software allows us to be a little bit more dynamic. You don't have to snap the levels every time you go from time frame to time frame, right? They stick where you leave them. Hi, Michael. Can we trade off of Trading View charts? Seems like double work if we can't. You can. I don't really know much about it as far as using it for trades, but I mean, if you're someone who works explicitly off the charts for trading, yeah, it might be a little bit more work for you. But remember, we're doing this for the analysis side. I still have my trusty 5 and 1 minute chart right here when I'm looking for triggers on entry and exit. right? I'm using TradingView, and even what I was using MarketScope for is just the analysis, highlighting the levels, knowing where I want to operate, and then yeah, it's going to make a little bit more work, Mark, to transfer over. Again, for all intents and purposes, you guys don't have to, but I just wanted to let you know, um, I'm going to be slowly migrating over. Okay, yes. Was wondering if it was because of market conditions now, Eileen. Oh, about the wider time frames. Yeah, like I said last week, guys, on the back of Brexit, it's prudent to take a broader look at the markets. You do not want to look at a 30-minute chart or stare at a 5-minute chart for a pair that's just made a 1,000 pip move. You can have no um, uh, what's the word? No sense of aspect of ratio of where we are um, in broader trend, and certainly makes for much more treacherous trading conditions unless you're a straight momentum trader. If you're a Momo trader, you really don't care. But even in these conditions, I think guys who are trading strictly off momentum, you really have to have that broader view of what's going on first. All right, so those are the three setups from last night: dollar CAD, Kiwi, and euro dollar. Again, we'll continue to monitor these heading into the close of the month. Be careful; it's just really not worth it. For me, I had a good month. I don't want to start really pressing the trades here into the close and mess things up. So I'm going to sit on the sidelines for now. We'll see if we can't get some flush out price action as we open the U.S. market. Like I said, if we get that spike in Kiwi dollar, definitely would be interesting in some short exposure there. Same thing with the euro. If you get a spike higher, would be interested in some short exposure there. A pullback into channel support might be an opportunity to actually press along. As far as dollar CAD is concerned, not really looking to play short from here. More so if we get that drop in some of those key levels, some possible long entries for the loonie. Okay, let's jump into some of your questions. Amir, you were first. Real interest in sterling yen and euro CAD. Here's what it looks like for. Well, let me do this first. Sterling dollar. There's really not much to talk about here on the 30-minute. Okay, it's really all about really the weekly and the daily. So I'm sure you guys have seen this chart. Okay, just a quick recap of where pound is in the broader scheme of things. We basically came off of basic channel support. This is a weekly chart, guys. So this, whoops. And by the way, you can lock the levels here too as well, so you don't have to worry about moving them around by accident again. But basic channel resistance off the 2014 highs, extended off the 2015 low. Literally caught the lows here. It also represents an exact 100% extension, 2 equal legs down from that high at 133. So the pound could see some support here. Also note that we've been getting some building divergence. These divergence signals sub 30, like I always tell you, they're super weak. So I really don't want to highlight that as a reason to try to fade this, but certainly it's something to pay attention to. Okay, so pound looking like it could find some support. Obviously, the gap would necessitate a move back into 136.75 just to fill that. So, not much of a play here in my opinion. Again, if you go back to the 30-minute chart, here's what it looks like since the open of the week. Really not much to work with. Okay, and this is not actually a small range, 131 into 135, basically a 400 pip range. Still, wouldn't be something I would necessarily want to attempt scalping even on a near-term basis. We've got some basic trendline support here to look at. So with that view, or with that sort of objectivity in view, with the fact that you're really wrestling with some major longer term levels, this is a multi-year Fibonacci level that you're looking at here. This is a multi-year trend line that you're looking at here, and you're coming off support, right? To take that and kind of shift it towards sterling yen, which I don't have a chart on market scopes. Let's jump back, or on trading views. Let's jump back into market scope here. Okay, you guys remember this chart. I really don't have anything to add, Amir, to this since we talked about it on Tuesday. The only thing I can tell you is that the level that we rebounded off of was very interesting for me. You're basically looking at the 2012 high. You're also looking at I'm lying. I'm sorry. That's incorrect. The initial 2012 high. 2012 actually closed much higher. But that initial 2002 opening or 2012 opening range high, you have a 786 retracement from the 2011 ascent, okay? And you're seeing that rebound hold pretty well. Now, where it goes from here, I don't think you're necessarily at resistance. You're certainly off support. So you're sitting mid-range. To fill the gap, you would still necessitate a move higher for pound yen towards 139.59 just to close the gap. So we haven't quite gotten there yet. Here's what pound yen looks like on the near term. Very similar to what pound dollar is doing. And Amir, if you want to give me a little breakdown, I mean, are you looking to establish a longer term position on this? Or is this something that you're looking to scalp? Because from my standpoint, I think that the pound could get a little bit of a pop higher here. But remember what Jamie said earlier, heading into the close of the month with all this rebalancing going on, and especially if markets spill over. So if we take a quick look now at what equity markets are doing, just to put things in perspective. Remember, the yen. Remember, the yen will typically. There we go. The yen will typically be a strong reactor to risk sentiment. So here's what equity markets look like so far, right, heading into the last day of trade. Okay, you have a mixed performance to flat over in Europe. You had sort of a decent performance over in the Asia Pac markets. If we look at equity futures for the U.S., we're pretty much also, we've been positive and negative throughout the course of the day. We actually just popped into positive territory, but not much, confidence on either side of the market right now. So if we do see yen strength start to materialize again, I think that this thing kind of just stays lateral, even if sterling is making a decent rebound. I don't want to say reversal because I do think you make inevitably a lower low. But just keep that in mind. You're fighting opposing forces here in pound yen. He says, I'm long. I just want an exit point. So for an exit point, again, I don't know where your entry is, but like I said, look for the initial resistance to sort of come in at the close that we made last week. So like I said, 139.59, Amir, is where I'd be looking for a resistance initially. Also, keep in mind that longer term chart here, that sliding parallel, I wanted to highlight right here in red. That comes in right alongside, especially heading into tomorrow, right alongside the close. Okay, so once again, basically looking just above that 139.59 level, maybe 139.70 would be that sliding parallel. All right. Your initial, Amir, any way you look at it, your initial target on a move like this is the gap fill. Because if it's just a single dead cat bounce in price, the market's going to want to fill that gap and then just turn right around. So keep that in mind. If it breaks through that gap, as we spoke about earlier in the session, now you're talking about one of those opening range plays where the market fills the gap, pulls back, and then breaks higher. That in and of itself would give you a subsequent topside near-term bias. Does that make sense, Amir? He says, yes, thanks. All right, cool. Right on. Hey, you're more than welcome, man. Okay. The other one you wanted to cover was Euro CAD. So we went over Euro Dollar and kind of those levels, right? Here's what Euro CAD looks like. Here's on the daily chart. Ugh, this thing's still ugly. So I got nothing to really say on this one, Amir, either. This is still the same exact setup that we highlighted on I think this was Monday or Tuesday rather. A 1618 extension off the high gives you 43.20. A 764 retracement off the low for the year gives you 43.30. So you're basically looking at 43.20, 43.30 as near-term support. The market's rebounded off that three times already. You had this day here. Obviously, this was the Brexit day. Couldn't even close below. And in fact, I was looking at this. The fact that EuroCAD couldn't make a close below that, and the fact that we rallied so hard on that day to close well off that support, for me says something. For me says something. And not only that, look at the momentum signature, right? You got that trigger break, didn't really take us into 60, but ever since 40 support, and you're basically holding still above 40. So for me, this is lackluster momentum, puts a slightly bearish hint on it, but nothing with conviction. And trying to take a long here necessarily wouldn't be the best play in my opinion, or at least the timing is not there yet. Here's what the EuroCAD looks like on the near-term chart. Yeah, oh boy, this thing's ugly. Let's just see if we can't get a better view on this. You see how resource intensive this platform is? This is one of the reasons as well. All these lags we get during our webinars is kind of frustrating. Okay. For me, this is actually looking a little more constructive as I look at it near term. And I'll tell you why, Amir. Um, First of all, right off the bat, look at momentum. 40, 40, 40, 40, 40. Got a couple of breaks into overbought territory or above 60. Not by much, nothing conviction, but certainly the 40 bounces have been real tight, real on point, right? So that's one thing to take note of. Secondly, the weekly open, it looks like, comes in right here at this 88.6 retracement. And look what's happened every time we've tried to test the weekly open. Test the weekly open, probe below, real sharp rally, right? Coming towards the weekly open, didn't even make it that low, real sharp rally. Just recently here, we probed below the weekly open, real sharp rally. Well, I wouldn't say sharp, but strong rebound, right? So could be a waning momentum signature here. There's a near-term trigger to the upside I want to keep an eye on. And again, let me just see what this looks like. Okay, so it could be the case, and this is an extremely ugly chart here, guys, but could be the case where you have just a near-term consolidation here, and you kind of want to wait for the breakout. Typically, these consolidation wedge triangle patterns will break, 10% into the apex. So basically, ahead of the apex by about 10% is usually when you'll see some sort of initial breakout of that formation. But other than that, that's all I'd be highlighting is play those ranges. What's this 618 from? Hold on one sec. So this retracement is better served using this low now. Yeah, okay. That's the weekly. Don't need that. All right. Yeah, feel free to take a snapshot of the screen here if you need it, Amir. That's what I would be looking at for EuroCAD. The weekly opening range never gave out, so you really don't have a conviction near-term bias in this heading to the close of the week, month, quarter. But I do know that you're getting a little bit more of a waning momentum signature, which suggests that you should see some sort of near-term breakout over the next 42, 72 hours. Basically heading to the open of next week, close of this week, you should see some sort of dramatic move here. Just from the coil that you're seeing in momentum and the coil that you're seeing in price, um, I'd be looking for something to happen over the next couple of days here. But till it does, I would treat it as a range. Okay? You're in the range until you're out. So either a concrete break below 43, which would be the giveaway for the downside, or a much more concerted break above the weekly opening range high, specifically 44.88 would be that 618, would sort of be the breakout play for a much more substantiated rally. Put a gun to my head, I would still favor the long side, but from a technical standpoint, we would need to see a little bit more of a basing price action here before getting too involved on the long side here. Amir says clear, appreciate it. Hey, you're more than welcome, and that is Euro CAD and pound yen. We are running towards the end of the session here, guys. So if you do have any questions or trade setups you want to review, Hussein wants to take a look at Aussie dollar. Here's what Aussie looks like right now. This is another one that we've been tracking over on the intraday charts for some time. Look, for the Aussie, I guess I'll start here with the daily chart. Pretty clear where we are in trend. Okay, I like that this thing filled the gap in overnight trade and has since pulled back below that 50 line for the current operative structure off the highs here. Here's what it looks like on the 30-minute. Okay, and there's that gap fill. Okay, now that gap fill was almost to the tick. We pulled off dramatically. This is your weekly open. We spiked below the weekly open, popped back above. So for me, kind of a little bit more neutral here. I would love to be in a more, let me say this, if we get up into 71.16, 71.75, this specifically is an area of which I would be really interested in some short exposure. It stays constructive, in my opinion, basically while above the weekly open. Okay, I know we briefly broke below that, but there's a lot there. Also keep in mind, if I break this, oh, I'm sorry about that, guys. If I break this into a 4-hour chart, for example, and we go back a little further, look what else is there. So you have this 50 line for the broader formation, some decent pivots in price, right? Comes right in line with the weekly open right now. So let's see if it can hold above this 74 region, 74.15 region, and see if we can make that push higher. The fact that we filled the gap and pulled back isn't very encouraging. I'm kind of on the sidelines here for Aussie. I kind of just want to be short from 75.70, or if you get a dip into the yearly open, might be an opportunity here to try to push along again. If we're going to stay within the confines of this formation, we came into the median line. You should be looking for support at the lower median line. And remember, specifically for the Aussie, this thing is super clean, right? This formation here, guys, caught the high to the pip, caught the low to the pip. There's the median line, a little messy, but it was a messy day. Not even the stretch was an exact 100% extension. So even during the Brexit debacle, prices continue to respect our levels here. So I'm not really sure what happens from here. You could get a move lower to test support. Again, this would be sort of a buy near the yearly open, in my opinion. Or if you get that rally specifically near that fib confluence up here, 75.72, April low day close comes in at 75.90. This would be a region of which I would be back interested for some short exposure here on Oz. Hussein says, thanks. Hey, you're more than welcome, Hussein. Okay, and you're pretty spent on Aussie data too for the rest of the week. Heading into next week, you do get trade balance data, retail sales. Don't forget on the 5th, we get the RBA interest rate decision. So that's going to be sort of the big player. The 5th is on Tuesday night. So definitely be aware of that, Hussein, if you're trading the Aussie. Mir wants to take a look at Euro, Pound, and Gold. Gold, I do have a chart. Or I thought I had a chart on MarketScope. All right, I stand corrected. Let me go back to okay. Here's what gold looks like. So, I just finished publishing the quarterly forecasts for gold. Those will be published on Daily FX over the next couple of days, probably over the weekend here. So keep your eyes peeled for that. Um, by the way, just so you guys know, anytime me and Jamie publish anything on Daily FX, you'll find those articles in our respective sections. So under intraday charts, on the bottom right, you'll see all the latest featured articles we put on Daily FX. Same thing if you go to the long-term charts, scroll down to the right, and you'll see the latest articles that Jamie's posted there as well. So just some information there. But for gold, this is basically the chart that I have on the report. Here's what the weekly chart looks like, and this is the one I think that you want to pay attention to at this point. Okay, the resistance level we ran into is so huge. I really can't stress 1359 enough. It's a 618 extension off the low, beautiful extension, perfect tag. It is the upper median line parallel for this formation, which has caught some really nice moves, specifically the lows on the entire declines, both for 2014, 2015. Obviously, the low of 2016 was just above that. And also you have just basic. Let's say you don't even do median line analysis and you're just using basic trendline resistance off the all-time record highs we made in 2011. Either way, both of them coincided dead on that 618 extension. So for me, I do think there's a risk of further pullback. The trade remains constructive in my humble opinion, while above that low that we made last week, basically this 50 line. A break below 1240 would be needed to shift the focus lower. But if we get a drop into this region, I think that's an awesome buy. Inevitably, I do think you break higher too, on account of a couple of different things. Remember why gold was under such pressure late last year? There were a couple of things. A, you saw that inflation's pretty much non-existent. Now, you can make that argument still now, okay? But let's just put that aside. And B, expectations for higher rates from the Fed. Right? We start off the year, now all of a sudden, as soon as we start off the year, things start getting shaky. Markets starting to turn over. You saw gold catch a huge bid. Expectations for a Fed interest rate hike start to fall out. Remember, you don't get paid. You don't get paid a dividend holding gold. There's carry charges. So if the Fed is going to hike interest rates, that saps demand for safe haven assets for things like gold. Now that the Fed's interest rate expectations been kicked out, you saw this uptick. And certainly if we do see the Brexit situation get messier or lack of clarity start to materialize, that could prompt gold higher. And although we don't have inflation now, and this is a whole conversation we can have later, but just for your information, what I'm thinking is although we don't have inflation now, with dollar strength starting to come up, you have interest rate expectations getting kicked out, and now the Fed kind of with his hands tied, inflation tends to rear its head much quicker in these types of scenarios. Okay? Remember, we've had a record low rates now for it's a precedent that the Fed has set. So once inflation starts to rear its head, it's not something that tends to be gradual. It tends to be something that kind of picks up pace. And one of the major classical uses of gold is that inflationary hedge. So I think moving forward longer term, yeah, gold could possibly see a pretty massive outbreak here if we clear that 1358 level. That said, immediately, right now, you are at resistance. Okay, I'm looking at that 2014 high week reversal close. That's the one that we made there in March of in 2014, a couple of years ago. You can see again that coincides with a sliding parallel for the current operative slope. Obviously, the 24th here, last week's price action, we're not going to stress that. Those are radical and huge moves based on lots of emotion, lots of market participants. So I'm not going to stress that breakout. And the fact that the breakout found resistance right there is encouraging. So near term, I do think you're at risk for a pullback lower, larger scale. I would be looking to buy, Mir. Does that make sense? Oh, this was for Hussein. Does that make sense? I'm sorry. No, this is for Mir. Mir, does that make sense for gold? He says thanks. He says thanks. Yes. All right. And again, just to keep in mind, your daily chart has all the same levels on it here. So if you want to take a snapshot of this, also, you can see that the 200-day moving average literally catching the lows here for the week. And look how momentum on the daily chart, Mir, really struggling to push above that 60 level. Okay, it's not bearish by all means, but it shows you that the top side momentum is waning, right? This is a higher high in price, higher high in price, higher high in price, lower high in price, and even these highs being equal as price action made a new extreme is still divergence. So on the near term, I think it's at risk, but broader, do like it higher. As far as euro pound is concerned, here's what euro pound looks like on the daily chart. That's coming to that major key resistance region that we highlighted last week. This is the basic trendline resistance dating back to March of 2009. Yep, right here. And then we tagged it again in September of that same year. I guess that's October. So that basic trendline resistance coincides perfectly with structural resistance of the current operative formation that we've been in. Obviously, Brexit charged a little bit of a back and fill throw over here, as is classic the case with any sterling pair. But that's still the major resistance region you want to keep an eye on. Basically around 83.50, 83.45 Mir is sort of the major region of resistance I'd be looking for. To fill the gap, you would still need to drop towards 81, basically. The close for Friday was right at 80.99. So yeah, let's just say 81. Note that you have a longer dated 618 retracement there as well. But yeah, I wouldn't be surprised to see some exhaustion here near term. For a drop down, at least that 50 line is where I'd be looking for possible re-entries. But you're at a pretty major structural resistance, Mir, here on Euro Pound. So be careful for the long side if you're holding that position here for Euro Pound. Any questions on that? And near term, I don't really have anything on this, so I wouldn't really want to stress it near term, except to say that since the start of the week, momentum signature has definitely turned a little less convincing as far as the longs are concerned. Here's your first break below 60, first break below 40, and ever since then, 60 resistance, 60 resistance, 60 resistance. Really shows you that the top side momentum is waning. You might see a small dribble down lower, which is nothing I would like to get involved in intraday, but certainly I think that pullback would offer a better opportunity for Euro Pound. All right. If you heard that ringing in the background, that's the U.S. markets opening here. So I got to run, guys. For all intents and purposes, it's the last day of the month and quarter. I really wouldn't be pressing anything too aggressive here. If we do have some scalps that present itself, really light on the leverage, stay nimble. I definitely, personally, from my standpoint, would not be looking to play an intraday position into the close of the session. That's when you're likely to see the things really start to see some massive swings on both sides. So let's get this close out of the way, open up a fresh month, and we'll pick up the pace again. I doubt that we'll have an update tonight, guys, unless there's anything that really pops up at us. So, I'll scour the charts, but usually during these conditions, I'm on the sidelines, really just playing with the longer-term charts, getting the game plan set up for next month so that we open up June trade or July trade. Jesus, it's really running through with a little bit more of a clear-cut game plan. All right. Enjoy your holiday. Thanks again. Have fun redoing your charts. Yeah, thanks for that. Guys, have a great weekend. For those of you stateside, enjoy the long holiday weekend. We will pick things up back on Tuesday, obviously, with our intraday strategy webinar at 8:30 Eastern as scheduled normally. Best of luck trading, guys. Cheers.